Welcome back to the Investing Show. Joining us now in the studio, we've got Tom Becket of Psigma Investment Management. Tom, welcome back to the show.
Thanks, Simon. Thanks for having me.
Now, markets, after having risen in something of a straight line at the end of last year, have been a little bit more volatile over recent months.
Yeah.
When you look at that, do you think that's to have been expected, and do you think that's the kind of thing that's going to continue?
Yeah, I think definitely to have been expected, and I think that we are in for a more bumpy path as we move forward from here. That's not to say that investors won't make money, but I think it's going to be harder to make money in the next few months and indeed the next few quarters, and perhaps actually the next few years, than it has been in the 6 months since the initial election of President Trump back in November. I think that was a rare period of most asset markets all performing well together in an era of low volatility, which I think, like most summers before this one, are likely to get punctured at some point, I'm sure.
And we've seen the second round of the French election now. Monsieur Macron won, as expected, a fairly crushing victory.
Yeah.
Do you think that some of Europe's problems are out of the way now, or are there more to come down the line?
Yeah, I'm just very pleased that the French election cycle is now over and we can focus on other things like German elections, but that's a bit later in the year. But I think in direct answer to your question about are Europe's problems over, if you look at markets would tell you that they are. I have a much more sceptical view of Europe, and I think the election itself of Monsieur Macron perhaps is more dangerous than people actually probably realise. I think that there is a chance that people like Mr. Juncker and people like Frau Merkel and indeed Monsieur Macron himself see what's happened in France as the green light for go for the reignition of the European project. I think that if you saw in the first round of the French election voting, and indeed with examples like our decision to leave the European Union, Euroscepticism is rising across Europe, and in particular in places like Italy, which I think will be the next flashpoint within Europe. So I think the concern for Europe is that actually they believe that there is no problems and problems are being solved. But I think the three things which created issues and led to Madame Le Pen doing better than many people suspected in the first place, migration, terrorism and a moribund economy in many places in Europe, are probably here to stay. And I think that really sets the scene for a French election in 5 years' time, where I think that one of the Le Pens, perhaps the junior version of the Le Pen family, has a decent chance of winning that election. I think that Europe is in danger of forgetting quite how grave the problems in the region are and believing markets that all is good.
And what was it? She got over 30 million votes or something, so she was hardly an also-ran. So.
Well, I think the total votes directed towards the National Front were about 11 million votes. Now, contrary to what the BBC might say about them being very far right and extreme, that doesn't strike me as being an extreme party. And actually, if you look at some of the policies of the Front National, some of them obviously are not necessarily politics that you want to see, but actually some of the policies aren't totally ridiculous. So I think they're no longer an extremist party. And I think that France has to realise that they now also have a political weight. And I think if they were to ignore that, I think that would be another problem which the Eurozone and politicians there could make going forwards. Now, as we know, European politicians, as we've seen through the early stages of the Brexit negotiations, are quite good at putting their foot in it. But let's hope for a period of stability and prosperity in Europe for the next 5 years. For choice, I'm more sceptical. I think that what you're seeing in the Eurozone markets and the Eurozone economy is more cyclical than structural, and I think the politicians should really recognise that and try and sort out some of the problems.
Just before we go on to Europe as an investing proposition, I read something that you wrote the other day talking about complacency, basically, and it was talking about the UK election, and you thought there was a lot of complacency going on with the Conservative Party, for example, in relation to the Brexit negotiations. Where they seem to be thinking it'll be fine, we'll sort this stuff out. The EU's just being awkward, but we'll be fine in the end. Do you think that complacency is something that's also shining through in Europe as well, and potentially there's more of a risk of it with the French election having gone the way that the EU would have wanted, that what Europe needs to do is avoid getting complacent over the next 5 years?
Yeah, I mean, I think that in linkage to your previous question, I think that is the biggest risk. I think there is an enormous amount of complacency, whether in terms of political attitudes or indeed in financial markets and asset prices. So let's just think about where the complacency comes. I think in the UK, I think there's a certain amount of complacency towards our own political situation. I would expect the Conservatives to win a sizable majority, but nowhere near the size of the majority that's been talked about in some of the press. I'd expect the majority to be much closer to 50 seats rather than 100 seats. And I think really that's when the hard work has to start, because let's be honest about this, the European politicians are stupid enough to cut off their own noses to spite their face with regards to our Brexit negotiations. And frankly, they won't recognise this, but the best thing that could happen is that the Eurozone is strong and the UK is also strong at the same time. Now, I think there's a lot of complacency towards the belief that the exit from the Eurozone is going to be anything other than messy. I personally think that the negotiation is going to be very protracted and perhaps pointless in the end. And I think also there might have been a switch, and you guys would know as much about this as I do, in Theresa May's mind recently, that when she says that a no-deal situation is better than a bad deal situation, I think she really means that. And I would be not unsurprised if we got to 23 months' time or 22 months' time and found that no deal was struck with the European Union and we went our own way there afterwards. That might not be too bad a thing.
Traditional wisdom, that's very interesting. Traditional wisdom. Markets will out. They will look at the economy, companies, what they're doing ultimately. And obviously politics is there, and it's something we all need to bear in mind, but it's something of a sideshow. In other words, it has no long-term impact on markets themselves. Has that non-relationship now broken down? Because a lot of what's happened over the last year, including Trump, including Brexit, and obviously where we now are, it does seem that politics is front and centre, or is it just because it's being reported in the media?
Yeah, it's not just because I like you, Richard, but I totally agree with your point. I think that's absolutely right. The political cycles are linked to short-term market movements and sentiment, but ultimately you're right. If the economy is doing well, people are spending money, asset markets should perform well in that sort of environment. And I think really that's what you've seen in the last year. I mean, everyone's ascribed the Trump bump in markets as being down to political policies still yet to come, of course, from the Trump administration. Actually, let's be honest about this, the economy kind of bottomed last summer, inflation expectations started to pick up. That's what drove assets like equities and stock markets higher and commodities higher in the short to medium term. So ultimately the economy will win out. And I think that's where I start to have problems, not just with Europe in answer to your question, Simon, but also in many other parts around the world, because I find the levels of valuations in certain markets like the US and also the creeping valuations in Europe has not been commensurate with the dull but not disastrous economic outcomes that I expect for much of the developed world in the next few years. So I think that there is now a growing gap between economic reality and the hope and expectation seen in financial markets. And going back to your point on complacency, I think ultimately the reason the sum will be more volatile is there's going to be a lot more push and pull between economic hope, economic reality, and the translation thereafter into asset prices.
And so when you look at Europe, does that present opportunities in there for an investor? Do you think there are opportunities in there, but you've just got to be very careful about what you pick?
There's asset markets all around the world that offer opportunities, and I think within those headline asset markets, great pockets of individual opportunity within a number of different regions and sectors, and it is our job as investors in an increasingly difficult environment to find those opportunities. But I think Europe really is a very, very special case at this point in time, because I'm told it's a contrarian investment opportunity by absolutely everyone who loves it, which now appears to be everyone. It doesn't strike me as being that contrarian, but there are some opportunities. But I think you need to focus on those companies which are going to enjoy somewhat of a cyclical short-term uplift in their profitability, and that would lead me to sectors like the financials, perhaps some of the European consumer stocks, the more cyclical nature, which I think could do well as we move forward from here. But be very, very simple about your view on this. My view on it is actually that it's a short-term cyclical improvement, not the sign that Europe is suddenly going to enjoy an economic renaissance driven by the Emmanuel Macron and Angela Merkel partnership over the next 5 to 10 years. I think you make some money out of Europe and you probably get out of it relatively quickly.
So over the next 5 to 10 years, there's better places to put your money, do you think?
Yeah, definitely. I'm just come back from India. I landed back yesterday morning, which is probably contributing towards my dishevelled state. That's a wonderful opportunity. Now, if I juxtapose the situation in India against that in Europe, you've got stock market valuations which are similar. In Europe, you're probably going to see 10% earnings growth this year and maybe, hopefully, something similar next year. You're going to see compound earnings growth in India of 15 to 20% per annum in perhaps the next 3 to 5, maybe even 10 years. I think you've also got a great situation whereby demographics in India are wonderful. In Europe, they're ghastly. And you're at a much earlier stage of development in India. So if I had to think about one of those places as an opportunity, Europe might be cyclical. Watch the American money flow into it now after the election as that money starts to drive asset markets up. But from a long-term perspective, it's definitely still places like India, China and Vietnam, which I think our clients will make the most money out of over the next 10 years.
And one of the other places that you were keen on in years gone by was Japan.
Yeah.
Are you still keen on Japan?
Yeah, but it's going to contradict much of the argument I've made so far, because obviously Japan has awful demographic situation, is completely overflowing with debt, but there's a different dynamic within Japan. Stock markets there are cheap. Everyone still hates it, and I think finally companies there for the first time in 30 years recognise that the cult of a shareholder is quite important. They're actually now doing things to try and make shareholders like them, buying back their stock, focusing on dividends, actually trying to generate returns on the assets they own, and making money. These are new concepts to Japanese corporate managements, which might seem somewhat more normal to us in the Western world, but I think those sorts of things with lowly valuations should mean Japan is still quite a good money to make recovery returns from in the next few years. So again, going back to my point, I think the world is still much opportunities, but you need to look much harder for them, and actually out in the East is still where I'm finding the best opportunities for our clients.
And Richard, there's a number of companies in the UK that you can look at to try and take advantage of those opportunities, aren't there? You don't need to just be investing in those overseas companies.
Yeah, that's right. I mean, a couple of the things that we have had and are having in terms of so-called developing countries is, number one, the move between rural and urban, and number two, of course, the emergence of a middle class. And that latter point in particular was going to be seen as massive in China, for example, as they started to adopt more Western medicine. So that was going to be good for pharmaceuticals, not necessarily washed its way through that. But quite apart from the strides that the likes of India are making, there are ways to access that country, as you rightly say, via UK companies, because it can be notoriously difficult, stock specifically, to invest in those countries, China in particular, although obviously you've either got fund management expertise to go for, or indeed a broader fund.
One of the countries that you mentioned there, actually, when you were talking just quickly, is Vietnam.
Yeah.
What's it that you like about Vietnam?
Well, I think some of the things which you can echo from my argument on India: wonderful demographics, a young and increasingly educated population, a lot of pent-up demand, and I think most importantly, Richard's clients, my clients, our own personal ISAs, money going into those markets trying to seek a return, which is frankly going to be very difficult to generate in the developed world in the next 10 years. So I think that all those things should mean that those economies continue to develop, and increasingly an Indian consumer, going back to Richard's point, a Vietnamese consumer, a Chinese consumer, they want the sorts of lives we have. They want to eat the things that we have. They want to wear the same clothes, perhaps not as bad as my clothes that we have. That's the sort of thing they want, and those sorts of things are great for opportunities. So I don't talk about the UK equity market too much, because I tend to think about things from a global perspective, where your comments are absolutely correct, is that there are wonderful UK companies where you can buy into emerging markets and good developing growth and benefit from that. I think one of the interesting sectors, in addition to your pharmaceutical comments, is actually the resources sector. At the start of this year and last year, it went absolutely to the moon. I think resources companies last year, you had to struggle not to make 100%. Started off this year fantastically. The resources sector was up 15% and has collapsed by 30% in the last couple of months. Does that now offer an opportunity? I would argue quite possibly. Try not to catch falling knives when it comes to investments, but some of those companies, the Rio Tintos of the world, which were loved a few months ago, now have a great deal of scepticism ascribed to them. But if Vietnam and India do continue to develop, they're going to need to do exactly what China did: put in infrastructure, build buildings, put copper wiring into new social housing. Those sorts of things could mean that the recent downturn we've seen in the resources sector actually is a good buying opportunity in the medium term for clients. And that's one of the things we're evaluating at this point in time.
Tom, that's all we've got time for.
Thank
you
you
very much. Richard, thank you very much.
Pleasure.
Thank you very much for watching The Investing Show. Join us next time. Goodbye.